Let me start by saying this slowly. If you are over 60, if you're retired, semi-retired, or planning to retire soon, if Social Security, a pension, or retirement savings matter to you, then what I'm about to explain deserves your full attention, because there is a new IRS rule quietly put into place that could save some seniors thousands of dollars over the next few years. And here's the problem. Most seniors have no idea it exists, not because they aren't paying attention, not because they did something wrong, but because this rule was not announced loudly, it wasn't explained clearly, and it doesn't come with a letter in the mail saying, "Congratulations." So today, I want to slow this down, calmly, clearly, no hype, no panic, just facts, because missing this rule could cost you real money, and understanding it could protect your retirement income. Let that sink in. Why this matters more than you think. On the surface, this might sound like just another tax update, and I know what you're thinking. You've heard that before. But this one is different. This isn't about a tiny deduction. It's not about complicated loopholes only accountants understand. This is about how the IRS now treats income for seniors, and that affects how much of your Social Security is taxed, how much of your retirement withdrawals are taxed, how long your savings last, and how predictable your monthly budget feels. This matters for your retirement, because once you're retired, you don't have many chances to make it back. Every dollar counts. The big mistake many seniors are making. Many seniors are still planning their money under old IRS rules, rules that no longer apply the same way, rules that assumed required withdrawals at earlier ages, different income thresholds, less flexibility in how and when money is taxed. But the IRS has changed the landscape, quietly, and if you don't adjust your thinking, you could pay more tax than necessary, trigger higher Medicare premiums, push more of your Social Security into taxable territory, not because you earned more, but because you didn't know the rules changed. So what is this new IRS rule? Let's explain this carefully. Over the past few years, the IRS has made a major shift in how retirement income is handled for older Americans. This includes changes to required minimum distributions, also called RMDs, changes to penalties, changes to timelines, and changes to how income stacks on top of Social Security. The most important part? The IRS now allows many seniors to delay certain withdrawals longer and control taxable income more strategically. That's the opportunity, but only if you know how to use it. Let's talk about required minimum distributions, RMDs. For decades, the rule was simple. Once you reached a certain age, the IRS forced you to start withdrawing money from certain retirement accounts. Whether you needed the money or not, those withdrawals counted as taxable income, and that often caused problems. It pushed seniors into higher tax brackets. It increased taxes on Social Security. It raised Medicare Part B premiums. But here's the change. The IRS has raised the age at which many seniors must start taking these withdrawals. That sounds small. It's not. Why delaying withdrawals is a big deal. If you don't have to take money out yet, that money can stay invested longer. It keeps growing tax deferred, and it doesn't add to your taxable income this year. Lower taxable income can mean less tax on Social Security, lower Medicare premiums, more control over when you pay taxes. Control matters, especially in retirement. Let's use easy math. Imagine you normally had to withdraw $25,000 this year. That $25,000 gets added on top of Social Security, pushes more benefits into taxable income, might increase your Medicare costs. But under the new rule, you don't have to take it yet. That means $25,000 does not show up on your tax return this year. Your taxable income stays lower. You keep more money in your pocket now. That's not theoretical. That's real. And for some seniors, the difference over several years can be thousands of dollars. Why so many seniors are missing this? Because the IRS didn't send a postcard. Because financial headlines focused on younger workers. Because many seniors assume, if no one told me, nothing changed. That's understandable, but dangerous. Tax rules don't care whether you noticed them. This is where it gets complicated. Just because you can delay withdrawals doesn't mean everyone should. This is not a one-size-fits-all rule. Some seniors need the money, are in lower tax brackets now, or want to reduce future required withdrawals. That's okay. The mistake is not knowing you have a choice. Choice is power. Another part of the rule. Most people miss penalties. In the past, missing a required withdrawal came with huge penalties, so seniors were terrified of getting it wrong. The IRS has now reduced those penalties. That doesn't mean you ignore the rules, but it does mean less fear, more flexibility, less financial punishment for honest mistakes. That's a big change in attitude from the IRS, how this ties into Social Security. This is critical. Social Security becomes taxable based on your total income, not just benefits. Withdrawals from retirement accounts count. So if you can, lower withdrawals now, or spread them out more evenly, you may be able to keep more of your Social Security tax-free, or reduce the portion that's taxed. This matters for your monthly cash flow. Let's clear up some common confusion. Myth number 1, this doesn't apply to me because I'm already retired. Not true. Many parts apply because you're retired. Myth number 2, the IRS would tell me if it mattered. They don't. It's your responsibility. Myth number 3, if I delay withdrawals, I'll lose the money. No, it stays yours. It just stays invested longer. Myth number 4, this only helps wealthy seniors. Wrong. Middle-income retirees often benefit the most. Who this rule helps the most? This especially matters if you rely mainly on Social Security, you have IRA or retirement savings, you're worried about rising Medicare costs, you want predictable taxes in retirement. Even modest savings can be affected. This is not about being rich, it's about being smart. What you should do next. Let's make this practical. Here's a simple checklist. Step 1. Confirm your age and whether RMDs apply. Yet. Step 2. Review your retirement accounts. Step 3. Estimate your total income with and without withdrawals. Step 4. Look at how withdrawals affect Social Security taxation. Step 5. Decide whether delaying helps or hurts your situation. Step 6. Document your plan so you don't forget next year. No panic, no rushing, just awareness. Important fine print. You need to know this rule does not eliminate taxes forever, does not apply the same way to every account, does not mean you ignore future deadlines. Eventually, withdrawals still happen. The goal is timing, not avoidance. Timing can save money. Why timing is everything in retirement. When you were working, income was steady. In retirement, income is optional, flexible, and strategic. That's new territory. The IRS rule recognizes that, but only if you use it intentionally. Why this feels overwhelming, and that's normal. A lot of seniors feel tired of keeping up. That makes sense. Rules keep changing, headlines exaggerate, advice feels conflicting. That's why we slow this down. You don't need to master tax law, you just need to know what questions to ask. Scarcity and time, sensitivity. Here's the part you shouldn't ignore. This rule applies now, but tax years move quickly. Missed opportunities don't roll forward. Once a year passes, it's gone. You can't retroactively fix bad timing. This is why awareness today matters. There is a new IRS rule affecting seniors. It changes when and how withdrawals are required. It can reduce taxable income now. It can protect Social Security benefits. It can lower Medicare costs, but only if you don't ignore it. The biggest mistake is assuming nothing changed. Something did, and it affects your retirement.